Good morning, everyone. It's Matt Donahue with Mission Financial Planners. We're going to jump into what's going on in the markets right now. But first of all, happy St. Patrick's Day. I hope you get to go out and celebrate with your friends and family if St. Patrick's Day is important to you. If you've been watching the headlines, you've probably seen the escalation involving Iran and the broader Middle East. You've probably felt the impact because markets have become more volatile. Oil prices are swinging, and expectations around interest rates are shifting quickly. This is not just noise. It's a real macro event that is working its way through the system. So let's anchor what's going on in some real data. Fourth quarter GDP was revised down to just 0.7%, which tells you growth is already slowing. At the same time, inflation hasn't disappeared yet. Headline CPI is still running at 2.4% year over year, and core CPI is at 2.5%. PCE, which the Fed watches closely, is even higher at 3.1 headline and 2.8% core. If you have a slowing economy and still sticky inflation, and you're layering in a geopolitical shock on top of that, well, you've got a unique situation going on. Where you're seeing the shock really hit is most clearly in oil. We've seen crude trade in an enormous range from roughly $76 a barrel to as high as $119 a barrel in a very short period of time. It has settled to closer to $99 a barrel. On average this month, oil is up about 30% month over month and about 25% compared to last year. That kind of move doesn't stay isolated because it feeds directly into inflation. Historically, every 10% increase in oil prices adds about 2.7% to energy inflation and roughly 25 basis points, 0.25%, to headline CPI. So if oil stays elevated, that puts real upward pressure on inflation expectations. The market's already adjusting. Since the end of February, we've seen about 40 basis points. That's about 0.4% of expected rate cuts for 2026 get priced out. That's a big shift in a short amount of time. The Fed is widely expected to hold steady at the next meeting, but the real question is how long rates are going to stay high if inflation proves more persistent. Let's shift to how markets are responding. The S&P 500 is down close to 3% year to date. NASDAQ is down even more, reflecting pressure on growth stocks as rates stay elevated. At the same time, yields remain high, with the 10-year Treasury around 4.2% and the 30-year around 4.9%. That tells us that the bond market has not fully bought into the idea of a quick return to lower inflation. We have slower growth, sticky inflation, rising geopolitical risk, and a shift in rate expectations. All that's happening at the same time. And that's why everything feels uncertain. Here's the key point. Markets themselves are not what creates stress for you as an investor. It's how you interpret what's happening that drives the decisions. And those decisions are ultimately what determines outcomes. At Mission Financial Planners, we stay focused on what we can control. We look at portfolio structure, making sure diversification still makes sense in a changing environment. We look at tax strategy, because in volatile markets, how you manage gains, losses, and income can make a real difference. We look at retirement planning because long-term success is not built on reacting to headlines. It is built on having a plan that works through environments like this. Volatility is not new. Geopolitical conflict is not new. What matters is staying disciplined when those things show up. If you're watching this and wondering how this environment affects your plan, now is a great time to have a conversation. We are here to help you stay organized, disciplined, and make informed decisions no matter what the market is doing. Stay focused, stay disciplined, have a great St. Patrick's Day, and we'll see you next week.